Welcome to the latest episode of our podcast series for financial advisors. Today's episode is The Valuation Playbook, Ted Jenkin on the metrics and mistakes that matter. It's a conversation with the co-founder of JPTD Partners and a leading voice in the M&A space for financial advisors. I'm Louis Diamond, and this is the Diamond Podcast for Financial Advisors.
At Diamond Consultants, our mission is to help advisors live their best business life. We want every elite advisor to find exactly the right place for their business and their clients to thrive, whether it's at a wirehouse, a regional, boutique, or independent firm. As the industry's leading recruiters and consultants, we've transitioned more than $250 billion in assets under management in the past decade, and each year, 25% of transitioning advisors who manage $1 billion or more are our clients. If you'd like to talk, please feel free to give us a call at 908-879-1002. Are you a financial advisor who's curious about whether you're in the best place to serve clients, or if there might be a better way to optimize your business for the future? Should I Stay or Should I Go is a new book that serves as a self-guided journey, walking you through the key steps that Diamond Consultants takes with our advisor clients, whether considering change or not. Visit diamond-consultants.com/thebook to learn more.
There's a growing chorus of advisors thinking about growth and life after their business, whether that means selling, merging, or simply planning for succession. But maximizing value and finding the best fit takes more than just timing. It takes the right strategy, the right partner, and a clear understanding of what truly drives value. Ted Jenkin knows that journey firsthand. A serial entrepreneur and former financial advisor, Ted built and successfully sold his own advisory firm, learning firsthand what it takes to go through the process as a founder. Now he's on the other side of the table, serving as an M&A consultant at JPTD Partners and a sell-side M&A advisor through Exit Stage Left Advisors, all while still helping other advisors navigate the high-stakes world of valuations and deal-making. In this episode, Ted shares what every potential seller or advisor seeking to maximize their long-term value needs to understand, starting with how to think about valuation, what multiples really mean, and the biggest mistakes he sees sellers make. He talks about the differences between fit and price, what the best buyers in the space have in common, and why the work you do before you go to market may be more important than anything that happens during a deal. If Ted sounds familiar, you likely came across a sharp analysis and direct no-nonsense commentary on Fox News, CNBC, and the Wall Street Journal. And because he's both a practitioner and an educator, Ted brings a rare combination of tactical insight and real-world experience to the conversation. Whether you're just beginning to think about an exit, already in discussions, or advising clients through their own transitions, this is a conversation packed with valuable insights. So let's dive in. Thanks for joining us today.
Yeah, thanks for having me on.
Absolutely. I've been looking forward to this conversation because your story and how you came into being an M&A advisor is fascinating. So let's start there. Let's start at the beginning, and maybe you could share a bit about your background and what first drew you into the financial advice business in the first place.
Well, I got into the business in 1991. It feels like ages ago, but originally started out as a financial advisor with IDS Financial Services and got into management then with what they came into, which is American Express Financial Advisors. And AB ended up being the youngest VP in the history of American Express Financial Advisors, and worked my way up the channel, and I became a group vice president. And then I was with them for 16 years. It was a long time. And during that time in 2005, they became Ameriprise Financial when they spun out American Express Financial Advisors. And at that time, I knew I couldn't stay in management. I thought maybe it would be great to start my own firm again after I had started in 91. And I came up with the idea that in the industry, in the blue ocean, nobody was serving the X and Y generation. So I was the first XY firm in 2007 called Oxygen Financial. The last 5 letters were XY Gen. I added an O. That's how the name Oxygen Financial came about. And I grew that company to more than $2 billion. And I eventually sold it in 2019 to Blue Spring Wealth Partners / Warburg Pincus. And that's what launched me to getting into the M&A business. After I did my transaction and everything I went through, I thought so many advisors must not know what life is like out there, who's doing deals, how it works, the way to negotiate them. And that's what got me into that business.
Hmm. How did you grow from 0 to 2 billion in a very short 14 or so years when you restarted your own firm?
So I never acquired a practice, Lewis. It was all organic marketing. And I basically came up with what I call to be a tradigital strategy. And yeah, it was part traditional, part digital, but it was all around media. And back in 2007, nobody knew really what YouTube or blogging was. And so I decided to start a blog. I remember going to the first FinCon, which was like a financial bloggers conference. I think the only other advisor there was Kitz's, and that's where I met Kitz's there. I created that blog, which I got at the time, my Alexa ranking under 100,000, and I was getting tons of leads from it. Then I went in to do not a traditional radio show, like not one that was like your Saturday guy, retirement guy, but I took the most risky shock jock show in Atlanta called The Regular Guys. It was like a Howard Stern show. And I just went in as a regular financial guy on that show, not to talk about Roth IRAs, but just talk about money and take call-ins and have fun. And then I eventually learned how to do TV. I never hired a PR firm, but by 2013, I was the weekend personal financial expert for CNN's Headline News. And I did that for 8 years. And so today, Lewis, I'm still an op-ed writer for Fox News. So it's an interesting world. So I did everything. I did traditional media, digital media, all to generate leads.
It's so interesting. And was that kind of the plan all along, was to use your marketing and media expertise or interest to scale a business without acquiring businesses in the process?
I've been a big believer that there's only two kinds of marketing. There's push marketing, and pull marketing most advisors can't do because it takes time and money to basically build a brand where people want to come at you. Like people want to come find out more about you. And most advisors don't have the money or the patience to do that. I did. And that's the way that I built it out. It was a 360-degree surround sound that people said, man, I see you on TV, or I read your blog, or I heard you on the radio. And we were at one point, Lewis, where I think Oxygen was getting 40 to 50 inbound leads a week.
Wow.
Yeah, people saying, I want to talk to you.
That's amazing. So why did you sell then? If you were able to grow that quickly, you had all these leads, wouldn't you have been better off just growing the business another couple of years, or just keep growing in perpetuity?
There were two main reasons that drove me to sell. Number one, I love marketing and I love sales, but I realized I hate service. There are a lot of people, Lewis, that would have said, well, you could have just hired a bunch of, I call them indoor cats, but really like junior advisors to go service all the clients. You play lead doctor, shake some hands, hand them off. But I still care about the clients I was servicing. And I got so deep into it, doing 20, 25 meetings a week, and it just burned the hell out of me. And it was one of the reasons why I wanted to sell, was just for me to escape that day to day in the business. And then two, when I started to understand the multiples of how private equity was buying these businesses, and I ran the math, I'm like, even if I do grow this thing, what if capital gains rates change? What happens if we get compliance issues? What happens if I have health issues? What happens if there's margin compression? And the velocity of the private equity stock, how fast would that grow relative to the stock of my own company? And for a good advisor out there, Lewis, like if you really do the math, like take your emotions out of it, it'd be hard to see over a 15 to 20 year time frame how you're not better off selling.
So let me play a little bit of devil's advocate. What if we applied your logic, but instead of selling now, I wait 3 years and I've grown 15% compounded each year. My firm's now larger. How would you respond to that?
Yeah, I would say that your 15% growth and the value of your stock will not be faster than a compounded annual growth rate of a private equity stock over 3 years. Under no circumstances can you do the math to make that work. It's why if you like really study investments, and I think most advisors do, but then again, Lewis, when I talk to a lot of them, I think maybe not. If the S&P 500 has done 10% over the last 25 years, I encourage every advisor listening to this to see what the private equity index market, if you will, did over the last 25 years, and it's doubled the return. It's why all the wealth in America is built in private business and real estate. So you do the math yourself. It's like two trains leaving Chicago. The train of your business will not move as fast as the private equity stock. It will not.
It's so interesting. Yeah. So walk us through your sale process and your journey. So you decided you wanted to get out of the business, wanted to take advantage of the multiples, take risk off the table, didn't want to service clients anymore. What types of firms did you look at, and how did you run your process and eventually land on Kestra's Blue Spring as the acquirer?
Yeah, so I do M&A and everything, but in going through this process, I would tell most advisors that no matter what the money is, 51% of this is culture fit. And so the main reason I ended up at Blue Spring is I didn't have to repaper my entire book. Like I didn't have to touch anything. And I probably could have gotten a little bit more money going somewhere else. But the truth is, I already knew leadership there. I knew all the systems. I knew how the whole RIA and the BD worked. And really, I didn't have to, nothing changed in my business at all. And so even if I got $5 million more to go somewhere else, would it really been worth it to just upset the apple cart for me and the 20 people that were on my team? Probably not. And so that's why I ended up there. When I do it for advisors, we take a real vetting process. Think about most advisors that do financial planning, and they gather facts and they also gather feelings. And that helps you as the basis of building a solid financial plan for your client. And we really don't do the process any different at JPTD Partners. We gather facts about the business. We build a really interesting financial data set that we put together. And then we gather feelings. There may be feelings between the partners, or it matters to a company to keep their brand name, or they want to do money management the way they're doing it. There could be a various number of factors. And that allows us to try to match up best the culture fit, also knowing the buyers that have the money.
Very interesting. If you can think back to when you sold and in the process, what was it like for you personally? Getting back into the feelings, like this was your business, it was part of your identity, it was your blood, sweat, and tears. And granted, it wasn't a 50-plus-year run or 30-year run like some advisors, but it was still your business. So what was it like for you personally going through the process?
I think like every owner of every business, financial services notwithstanding, number one, you're always asking yourself, like, is somebody pulling a fast one on me? What's the catch? And two, more importantly, you got to remember for 17 years, I wasn't an employee. So the thing that made me the most worried, Lewis, is like, oh my God, I'm going to be a W-2. And when I'm a W-2, are they going to make me wear a tie again? Am I going to have to show up to like a weekly raw meeting like, hey, let's go team and make some sales this week? And it really was probably my biggest fear. Like, what are they going to tell me to do? And what I found out on the other side surprised me a lot. I think I saw physically over 3 years, I think I saw the PE company twice. Yes, there were some financial calls, but nobody changed the way that I did my business. Instead, what I found is the PE company's like, how do we lighten your backpack? Like, you look like you're a fifth grader going to school with 9 books in your knapsack. Which 3 do we take out so you can run faster? Because we all win if you run faster. And that's the part that really surprised me. So what got off my desk? I didn't have to do payroll, HR, operational stuff, put together PTO policies. All that stuff was off my plate. I'm like, all I have to focus back on now is bringing in new money and doing what we do at Oxygen. And it was a real breath of fresh air relative to all the other day-to-day management stuff that I was doing.
And how much of that was because of the nature of who Blue Spring is, which is more of a aggregator, if you will, where advisors keep their brand and they keep their way of doing things? Like I would assume you probably would have a different answer if you sold to one of the integrators. So the firms that buy the whole business, change the brand, and kind of meld everyone into one model. So do you think for you, since you were reluctant to be a W-2 again, and I think there was value in what you're doing differently than other firms, that just the nature of who Blue Spring was, which just ended up being the right fit?
Well, I think every advisor probably believes they have their own secret sauce, as did we. But in the end, I think the determination is, do you want to keep your brand, and do you want to manage the money the way that you want to do it? Because in some of the models, I keep names out of it today, they're going to say, listen, you got to change your brand, non-negotiable. We have our own way that we manage money, non-negotiable, right? And there are other firms that say, listen, we don't care. And to your point, it's a difference of being with an integrator versus an aggregator. And when I had those conversations, I love my Oxygen brand so much. I would never have done a deal with somebody who wanted to take my brand, and then I became some other name. I just didn't want to do that. So I think it's a big inflection point for people. Like, what do you want to keep and what don't you, namely brand and money management?
I think it's a good learning. I think of it in a very similar way. It's what do you want to keep control over? What do you want to relinquish? And then everything else starts to make more sense.
Yeah, 100%.
Is there anything that you wish you knew then that you know now?
Well, the number one thing for sure is I wish I really knew how private equity stock worked. Any advisor that goes through this process is going to see some Excel spreadsheet or some PowerPoint that says, hey, if you take 5 million in stock, in 5 years, it's going to be worth $20 million. And you're like, wow, that's crazy money. When Blue Spring recapitalized and Warburg sold Blue Spring and Kestra last year to Stone Point Capital, the recapitalization was close to a 4X. And I did take stock in my deal, but in retrospect, I didn't need near as much cash as I took in the deal. Had I taken more stock, my deal would have been even that much more valuable. So I think most advisors, their inclination is going to be, give me cash, and I get it. You're going to want to get some. But I think the real reality is you've got to be able to try to do your best to decide how valuable do you think that their stock is going to be. And that's an important part of this process, is being able to value the company like you would a publicly traded company the best you can and figure out what you think the stock is going to be worth.
It's so interesting because, when I see those spreadsheets or hear about the numbers, and it's like, okay, like the wind has to blow exactly 15 miles per hour northwest on Tuesday, and this has to happen. But I think you're right. Like ultimately, if you're entrusting your life's work and your clients to this firm, it at least means that you feel pretty good about the future of it.
Think about this. If you took 5 million in stock in a deal, I'll play this easy for advisors, and most of them likelihood is that they'll triple. So in 5 years, you're at 15 million, and then you let it sit for 5 more years, and now it becomes 45 million, which is how you create intergenerational wealth for your family. It's not going to happen because your practice goes from 2 million to 4 million. And even if it does, it'll never run as fast as what I just said over 10 years. It just won't happen. If you get on the right racehorse, right? And that's finding the right racehorse. So people that were in the early days of a company like Mercer or Mariner, as an example, both really good companies. In the early days of those companies, whoever was in it, when I know, they're rich because of that stock.
What about, I'd say most acquirers these days, at least the strategic buyers, would offer equity as part of their deal structure. Some require it, some kind of give you a dial to dial it up or down. But let's say some of the names that you just mentioned, the larger, much more mature companies, do you still think there's opportunities to double, triple, quadruple? Or do you have to pick a racehorse that's a little bit younger and has more room to run?
I think advisors need to be realistic about the environment we're in financial services, because these environments don't last forever. And when you have companies that are trading like Creative Planning or CI did, or even Carson did this, where they're getting a 20 plus multiple on EBITDA, it's how those companies are able to offer you so much money for your practice today, because this is a game of leverage and a game of arbitrage. And so when you look at the bigger mega RIAs, Lewis, in the business today, it's going to be really difficult for them to sell out to other private equity companies, because those companies that buy them are not going to have much room to make money. So the only path for a lot of these companies will be to go public. Now, I'm not saying that Mariner, Mercer, and those companies will 100% go public. Creative Planning, 100%. But to me, the pathway to recapitalize, it's going to be much, much harder the bigger they get to recapitalize to another PE firm.
Yep, I think that makes sense. And also, if you look at there aren't that many public market comps for wealth management firms or RIAs. So you look at Focus was trading at a massive discount to probably what they're worth now that they're private.
Yeah.
And big companies like LPL Financial, Raymond James, Morgan Stanley, granted they're different businesses than an RIA, but no one's trading at a 22, 23, 24 times multiple on the public markets.
Right.
Let's talk about your pivot then. So you sold the business. How long did you continue working? And then why did you decide to leave the firm and pursue other interests?
So I had a 3-year employment agreement, which won't be uncommon for people that do a deal. And I had some bogeys to hit in terms of revenue retention and growth in the business to get all of my money in the deal. So the crazy part about this is that some of these deals are done market neutral and some are not. I didn't even think about it when I did my deal. And when I sold in July of 2019, for those of you in recent relevant memory, March of 2020, we have COVID and the market goes down 30 or 35% in a month. And Lewis, I cried. And I thought to myself, how in the hell am I going to dig out of this hole? And I say this for two reasons, right? One is you just got to be smart about it as you negotiate it and decide if you want market neutral or not. It can work for or against you, but you've got to have an organic marketing machine. And thank God I did. It was basically the saving grace for me, really, to hit all my numbers, as I knew we could bring in lots of new business. After those 3 years were up, I just thought to myself, what do I really love doing? I love this industry. I love the financial industry as a whole. What can I do to use my marketing skills that I built up over these years and my sales skills, but be in a business where I don't have to service? And so the whole M&A world became really appealing. And I first started at an M&A firm that was called Exit Stage Left Advisors. And this year we'll probably do between 5 and 600 million of transactions in that business. And then my old boss, which is crazy, like bring the band back together. My first boss, Scott DiGiamarino, and my last boss at American Express Ameriprise, Peter Velarde, started this JPTD Partners. And I thought I could be real useful over time, just given my experience to help advisors sell. One, I did it and I know who the players are. And so I talk their talk and walk their walk.
Yeah, I really like it because I would imagine that having that empathy and knowing exactly the struggles that advisors have in growing a business, what it's like to be on the selling side of the table, it gives you a very refreshing perspective when working with advisors. So tell us a little bit about JPTD. So you mentioned that's the business that's focused on the wealth management industry, but can you just talk a little bit about the type of work you do, the types of firms you work with, et cetera?
So JPTD is basically a full service sell side only. We just sell practices. Is hybrid advisors, ones that have BD business, and also if they're an IAR of an RIA. I've done fixed indexed annuity guys. It doesn't really matter, but if you're in the financial services business, uh, whether you do 500,000 of revenue or you do 50 million of revenue, we help you sell your business. So we're not coaches, we're not trainers, we're not recruiters. We only do one thing. We know how to sell practices, and we will do somewhere in the nature of 40 to 50 this year of those transactions. I know there are a few other players in the industry, but I highly doubt that any of them are doing the level of transactional volume that we're doing right now. And so we've been able to curate buyers. Many of you know these names because they're big names, but we've also been able to curate a lot of names that, Lewis, I never even heard of them before we started doing business. To give you a great case in point, the Bagula family owns the Buffalo Bills and the Buffalo Sabres, but a lot of people don't know that they have a wealth management firm called Bison Wealth Management. I didn't either, but they're an example of a firm you probably never heard of that's in acquiring in the business. I found a firm, Lewis, that in the fixed indexed annuity business, yes, fire breathing dragon annuity people at Ruth Chris Steakhouse, I got somebody recently a 5 times revenue on an all annuity book.
Wow.
Yeah, I said that twice, right? Because that's people are like, come on, man, really?
That's crazy. Yeah.
Yeah, I'm happy to show you. Hit me up. I'll redact the contracts. One of the greatest moments I've had in doing this is with my good friend, Matt Jarvis. Jarvis puts a LinkedIn post up one day and says, I call bullshit on Ted Jenkin, that these numbers are not true. It can't be right. So I called Jarvis up. I go, these are not BS, Matt. I'll show you. Let me take your business to market and I'll get you these numbers. He goes, all right, you're not going to be able to do it. Just do it. And you know what? I did it. And it is what it is. This is the reality of where we are today at this time in the market.
How much of these deals, like you're saying, are a testament to just your connectivity and running a good process versus the fact that businesses these days are just insanely valuable?
I think naturally businesses are insanely valuable. So without us, somebody's going to be able to get a decent deal, right? I'm not going to say that. They're going to be able to find something. However, there's so many nuances in the way that you can fill air in the balloon that if you've never filled a giant hot air balloon, you're probably not going to fill it the best
Mm.
way that it should be filled. And it's probably like you doing recruiting. Like I'm sure somebody can get a transition package from a big broker dealer. Are they going to know all the points that they could negotiate? Are they going to know all the competitive factors out there? Are they going to know how to negotiate retirement packages and put options and how to negotiate their comp? They're just not going to know this stuff. And so I wouldn't expect them to. They're RIAs or they're just independent FAs. So we add that value and we only work on a success fee. So if we don't get something done, we don't get it done. And if we do, we're never going to take a success fee that's more than the delta of what we think we create in value. It just has never worked that way.
Very interesting. I couldn't agree more with your analogy as well. So let's talk a little bit about valuations. Everyone wants to know about valuations. Talked a little bit about it, but what are you seeing as far as valuations, valuation trends, and any sort of color that you'd be comfortable sharing?
Yeah. So I put this in the land of stupidville. I'm not telling you that this makes any rational sense except to say that the big RIAs are trading in the 20s. And it's the reason that you can get these kind of numbers today. There are many factors that can change this at any time. But a small practice, okay? I just did a guy, Lewis, who does 410,000 of production, which I'm not saying is nothing, not being disrespectful. It's small. And I got him a 4x on revenue.
Wow.
Okay. So even at that level, I know where the bodies are buried to get 4x. I recently had an RIA, all fee, no commission, no insurance, that got an 8.8.
Holy cow.
So there are magical numbers. 100 million is a mini magical number, 500 million, a mini magical number, a billion, a magical number. At $1 billion, you start to become a big time something in valuation. If I did it on the EBITDA side, I don't think I've seen less than an 8 on cash flow, but I've seen as high as 16.
Wow.
I know, which is insane. When you look at real businesses like HVAC companies, I've sold roofing, I've sold golf cart companies. None of these companies get double digits, okay? Our advisors in the industry don't understand. This is a unique time. Now, it may last for a couple more years. It's not going to last forever because the math won't make sense. There's going to be too many big companies that their only path is going to be to go public. So it's why I think advisors need to seriously explore it. Even if they don't do it, it just makes sense to seriously explore it.
Yeah, I completely agree. Those are crazy numbers that you reference as far as revenue, because that's usually how advisors know their business better than their EBITDA or their true normalized EBITDA or whatever the term is. But I agree with you.
Lewis, it made me think of something here that I'll give you a great example of fill the air in the balloon, and you'll appreciate this with the great work that you do. You could have two companies that offer you $20 million, right? But one company says your ongoing comp is a 15% payout, and one company says your comp is a 30% payout. And the way that you get paid ongoing comp will inevitably dial up or down the size of the hot air balloon, right? So a lot of advisors may not know that's just one dial of many dials you can hit to change the enterprise value of the business. So people that are listening to this think, oh, well, I do $1 million in cash flow. Ted's saying I'm probably going to get 10 to 12 million. I'm saying that's a barometer, right? The balloon's on the ground and it's flat. Now that we fill it, what do you want your ongoing life to look like? Are you thinking about sticking around for 2 years or you want to work for another 15? Are you interested in a second or a third bite of the apple? How much comp do you need to live your lifestyle? Do you have like 2 homes and 3 boats and a country club membership and you're used to making $1 million a year and you can't live on a $500,000 a year, which would be sad to say, but I know it's true. These are, I think, things advisors need to be thinking about as they exercise through this process.
I completely agree. Those are the things that you either miss or you wish you thought of or didn't think it was possible to ask for. But I've seen it too in a competitive process, whether it's a advisor considering transitioning their business or it's a sale, that if you have multiple offers, you have a competitive market, you have someone in your corner who knows what they're doing and they've done it before, typically the outcome is better than what someone could do on their own.
Right.
So aside from the mini magical numbers you said, 100 million, 500 million, a billion, In your experience, what do you think really drives multiples higher? So if I'm a $500 million practice, how can I say I'm going to get the most from my $500 million practice, absent growing to a billion or 2 billion?
So I will keep this super simple for everyone. And this is one everyone wants to write down. Every one of these companies wants to ride Secretariat. What I mean by that is that if you have an organic growth engine, you have a way that you can consistently bring on new clients, you take out the fluctuations of the market. Most advisors, your practice dies or lives, it grows, so to speak, at a general market rate, right? If the market average is 7% or whatever it is, that's generally what the CAGR number is going to be on a practice. But if you have organic growth, a provable engine to bring in new clients, it will have a multiplicative effect on the sale of your business.
Yeah, I've heard the same thing, but I think you put it in a very succinct and artful way. So I guess one of the things people would take from this is before thinking about a sale, focus everything on growing organically. I know it's easier said than done. Not everyone has a marketing machine or has that type of ability. But if you have the benefit of time and know how practices are valued and can begin with the end in mind, focus on organic growth. Know that's probably more valuable than, oh, this other business line or my client base is young. Like it seems like that's, aside from the size of the business, that's by far the most predictable way to maximize your value.
Yeah, because like in any business line, including ours, who wants to buy a business that's been flat over the last 3 to 5 years? And by the way, not that all companies get knee deep in your client base, but if they start looking at the client base and you're a car with a leaky tire, meaning your average client is 72, 73, you're losing 3 to 4% every year from RMDs and you don't have a fire hose to fill up the bucket again, it's a real problem because basically I've bought a car that has a tire that's going to go flat. And that's a problem. It doesn't mean that your business isn't value, but it would be more value if you were able to have a hockey stick for you growing it, which is also the optimal time for any business to go to market when the hockey stick is curved up, not when it's flattened out.
Yes, I couldn't agree more. You want to sell your house at the top of the market. What about though, like a lot of these big buyers, they have this incredible lead generation machine. They get referrals from the custodians. They have a radio show. They drive digital leads, like probably everything you did with your firm, but at greater scale. So if that's the case, why does a buyer really care that much about an individual advisor's organic growth? Can't they just plug you into their flywheel and expect that you grow?
So I think when advisors hear that, it's flawed logic. The way I see the industry shaking down and the way it's actually happening is your mega RIAs are going to dominate the CRP programs of Fidelity and Schwab. It's just the way that it is. Ye that has the most amount of assets gets the most amount of access, right? That's how this is going to end up. Outside of a couple of companies that were organically started by marketers, I have to say, I'm sure every single one of these companies is going to hate me for saying this, but their marketing's not that good. It's like they have a marketing department, but hardly any of them really have an engine that's going to generate lots and lots of new clients for you. There are a couple of firms, like I said, that have founders that are historically marketing gals or guys. There are probably 10 firms that are knee deep in that CRP program. But, even at that, it's not going to feed everybody.
Yeah, and also it's also a supplement, right? So if that lead flow dries up, or even if you get it and we can help you grow 20%, but if you also in addition can grow 15%, then it's everyone still wins. And I still see
Totally.
why someone would prefer to pay a lot more for a firm that can double over the next 5 to 7 years than a firm that's going to be stagnant or shrink likely because their clients are withdrawing and they're just living and dying by the market. Makes good sense. So without naming names, how do you categorize the best buyers in the market right now? Like there's so many firms that want to buy. We get a week from every firm under the sun. I know how I think through the best buyers in the market, but for you, like how do you pick through the bunch to have the folks that you like to recommend?
So I think the first decision tree is, are you looking to do a full deal or are you looking to do a partial deal? Because there are buyers that are experts at partial and there are buyers that experts at full. On the full side, I would say You normally look in those top 30 or 40 RIAs in the country, but you also need to be smart enough to follow the money. What does that mean, Ted? It means that if you're a drunken sailor, meaning you have a lot of money in your pocket, there's definitely the possibility you're going to pay more because you need to put that money to work. So when you read in the trade publications that ABC Company just raised $300 million, that's a great opportunity to go at them because they got to basically put it to work. They can't sit on it and make a 20% IRR in their money. Just can't do it. But I think your larger, well-funded, whether they're an integrator or an aggregator of RIAs are where I see the best deals, or what I would call to be mid-sized companies that are 5 billion to 50 billion, but they're well capitalized, right? They got a family office behind them. They just raised a couple $100 million. Those are the places that I see the best deals.
What about on the fit side? So valuation is critically important. It's why people hire you in many regards to get the highest valuation. But how do you help people think about the fit? What you said before is 51% of the equation.
What we try to think about with our clients is exactly the analogy I use. If you have 9 books in your knapsack and we could just get rid of 3 of them that would help your practice grow by 15 to 20% a year consistently, what 3 would we get rid of? And we're looking for the companies that have strengths in those areas. Maybe it's operations, maybe it's marketing, maybe it's tuck-in acquisition, maybe it's hiring CFPs to basically service BC clients, right? And trying to find the right fit that way with what helps the advisor lighten their backpack to grow faster. And not everybody does everything in this business, even though sometimes they say they do. And we try to search through it. Now, we have experience of having done 100 plus deals, right? So having done these many deals, we got to feel after the fact that advisors we've actually placed, and I know you've done this too, right? You place an advisor, then you get a feel of what's life after I place you. And that gives you even more insight to what the company can actually do and what they can't.
What about, I was thinking of a scenario I came across last week. You probably see this all the time. Let's say it's a $200 million firm who says, I don't want to sell or merge with one of the big ones. I want to have a voice. I want to retain control. And I want to sell or merge with someone who's a similar size or is 400 million. Do you typically see that thought process bear fruit, or is it usually a fool's errand for one reason or another?
Well, look, control is fool's gold, right? There's so many advisors that say, oh, I want to sell 20% because I want to maintain control. Newsflash, here it is on Fox News, on CNN. When you sell 20%, you basically sold the whole thing, right? How do I know this, Ted? Well, read the extended warranty, right? Read the fine print. And when you get into it, you're going to find out that your way out of that is not going to be to sell the 80% to whomever you want down the road. It's just not going to be that way. So a lot of advisors have that fool's gold. Like if I sell it all, I lose control. But if I only sell a little, I maintain control. The way you maintain control in my mind is you keep doing your own independent thing, right? And maybe you're the acquirer, not the acquiree, right? But it's any deal you do, even if it's a minority, you lost control.
Right. So meaning if, in my example, $200 million firm wants to sell or merge with the $400 million firm, they're still not going to retain control. Maybe it'll feel better and maybe you can have a voice to some extent, but do you normally see those deals happen, or is it just they fall apart because there's not enough financing? Or
look, even the advisors that try to put together their own patchwork quilt, they're like, look, we'll get a better valuation. You do $1 million, Lewis does $1 million, Scott does $1 million. Let's put us all together. In the end, everyone needs to be smart enough to realize you still have an operating agreement, right? That's the governing agreement of the practice. Most advisors don't really know what their operating agreement says. It's like, hey, I think it's on that brown book on the shelf. What does it say? And the truth is, when you do any kind of deal, a merger or otherwise, you might feel exactly like you're saying, like you have a seat at the table because you have a vote. But in the end, all those paths lead to you largely giving up real control. It might feel like you have some control, but you could argue that if you're an independent franchisee at Edward Jones or Ameriprise, you have all the control in the world. It's your branch. It's your franchise. Do you really? It's like false control is what it is.
so let me ask you 2 follow-ups from what you just said. The first one is if minority deals are really like selling the whole thing, which I agree with, when would it make sense for someone to sell a minority stake in their business versus not selling anything or selling the whole thing?
Well, a minority one can often happen for cash flow issues, right? Because you got some advisors that if they get put on a 30% payout, like you're doing 2 million of revenue and you were used to making 1 million too, and even though you got money in the bank, you're saying, I don't really want to touch that. And I can't live on 600 grand. Again, sad, but true for a lot of people because it's like, oh, I'm on my third marriage. I got 2 boats. I got kids at college educations. A lot of advisors simply, it's like the cobbler's kids, right? They don't do a good job of their own financial planning. Now, where a minority deal can be tremendously accretive is what's known to be in these drag tag scenarios. What does that mean? Well, you might sell, I'll keep it simple this way, a third of your business. But there's a contract that says that the parent company that bought you, if they do a recapitalization event or if they go public, the drag means that you be required to sell another third of your business. And the tag could say, well, you can sell the other third of your business if you want. And those scenarios can be accretive because you will tag into the multiple that the parent company gets. And even though you might only get a part of that multiple, it'd be far greater than you trying to do your own practice yourself. We see a lot of that, Lewis, now. There are a lot of companies that do that, including people that have sold companies and they're not even RIAs. They're just capital companies. A great example is, guarantee you hardly anybody here has heard of Aspen Wealth Management. Probably never heard of them. But they're a San Francisco PE company under Alpine that basically put together a model. And they're not an RIA. They're not a broker dealer. They're not an insurance company. They're a capital company. A lot of people know Joe Duran from the days of United Capital and selling to Goldman Sachs. And they have a company called Rise Growth Partners. And these are people that want to take capital stakes in businesses, but they don't want to be a back office.
Right. Makes sense. Yes, it sounds like financially, if a minority deal has the optional tag along or the required drag along rights, then it starts to make sense financially. And also, in my experience too, if there's a real strategic reason that you're going to sell a piece of your business, like we think if they invest in us, they're going to help us grow, they're going to help us acquire. Most of my net worth is tied up in my business. So it's not that they're bad deals; it's just buyer beware. That like once you sell any stake in your business, you're not in full control anymore.
That's totally true.
Yeah. Another question from what you said earlier. So I'm seeing a lot of we'll say the band of thieves approach, where it's the example you use. I have $1 million practice. You have $1 million practice. Joe has a $3 million practice. Together, we're a $5 million practice, which means we're going to get valued at a higher number. In practice, how do you see that coming to be? And is that actually true?
Yeah, this is like George W. Bush with the whole fuzzy math. Listen, when you sell a company, period, notwithstanding our business, you need to have one P&L. So if you all come together and you create one P&L and it's called ABC Incorporated and you can show a company one P&L, they might buy you as one business, but it's rare. I've seen it a couple of times. It's why the OSJ model sucks so much. And I hate to say it, everyone. I know if you're an OSJ, I'm not picking on you. I'm just saying it's a tough model because your value is zero. I know you think it's something, but you're going to find out in the end that it's not much or nothing. And it's because the company's going to go, wait a minute, you're telling me you do 10 million in revenue, but Lewis doesn't have the same technology. He doesn't do financial planning the same way. You guys don't even have the same P&L. You don't have the same staff. So now I have to corral, really not doing one offer. I have to do 3 offers and satiate all 3 businesses. And it's just very difficult to get a transaction like that done.
So, but is it that hard to merge P&Ls? Like, look, I know I spend X thousands of dollars on e-money and you spend this, and I know my real estate cost is Y, yours is X. I know you do X in revenue, I do Y. Is it that hard to create one P&L?
It's not that hard to merge them all into QuickBooks, right? But here's what gets hard about it is that if you're all underneath different operating agreements, we can all drink tequila and sing Kumbaya, but when push comes to shove and we all got to make a decision to say yes, let me tell you how that's going to fall apart, right? Where one guy says, well, wait a minute, I got to make sure my junior guy gets this. And another person says, well, my daughter's in the business and I've got to be sure she has a 3-year employment agreement. So you start to get down to all these one-offs of what everyone wants. And it's why like an OSJ, Lewis, that has like 8 advisors, they're like, hey, they all work for Eagle Wealth Management. No, they don't. They may use you as a DBA, but they don't work for you. They own their own book. You get like a 9% override. Good luck corralling 8 people to all agree on the
Yeah,
same deal at the same time.
completely agree.
I've tried them, Lewis. They're very difficult. And it's a very difficult model because you think about it as an OSJ. Somebody leaves your OSJ today, you got nothing. You're done. You lost all your override. And if all those advisors want to sell and you're thinking, well, I'm going to sell my overrides, no way. Because they don't want to buy 91% of the book. They want to buy 100% of the book.
Yeah, I agree. It's something that sounds interesting and sounds good on paper, but in practice, few are willing to do the hard work of actually making a cohesive business to make it happen.
Correct. Yeah. And I think people need to understand, especially too, Lewis, a more simple example. You got somebody who's listening to this, it does 2 million of revenue and they have 3 1099s in their practice, right? And they're like, why you have them as a 1099? Well, I don't want to pay the payroll taxes. Okay. Well, you're going to pay now or pay later. Because when you want to go sell that business, they're going to be like, well, first of all your 1099s need to become W-2s. Oh, they're not going to have any problem with that. Yeah, they will. And by the way, they're going to start saying, well, who really does own this book? Because all the clients
Right.
that are in here, I think I own them because I've been servicing them the last 15 years.
Yep.
So it just be smart, W-2, pay the damn payroll taxes. It's going to be much better for you down the road.
Yep. I agree with you. It is advice I normally give advisors. It's like, look, it's nice to be able to amass more advisors and get some cash flow. It's easier to sell people on becoming a 1099 versus a W-2, but you're going to regret it in the future because all of these advisors are flight risks, buyers see through it. And best case scenario, you're on a roadshow trying to convince all these advisors to sell. Worst case, your business is only worth what your book is worth, and you don't really have much else beyond that.
I totally agree.
So aside from not hiring an advisor like yourself, what are the biggest mistakes you see advisors make when pursuing a sale or merger?
Well, I really feel like internally, financial and legal are the 2 biggest mistakes. Number one, I'll just give you an example of financial. If you're at a broker dealer, okay, you're like a hybrid of an RIA and you got annuity business, et cetera, that goes to, and you're getting a 91% payout. And basically when your accountant runs your P&L, you're doing $2 million and that's what you turn over to the company. However, you're not really adding back in the 9% that the broker dealer is taking, which you need to because they're really buying your gross revenue, not the net revenue you get from the broker dealer. So that's just an example of where advisors don't financially, they're not really reporting the real saleable revenue, and or if most advisors may not 100% tell their truth on the tax return, even though they all say they would, adjusting out the real expenses in the P&L to make sure that EBITDA is accurate. And that's a very important exercise.
Yeah, so you're talking about like, oh, my country club, which I use occasionally for client entertainment, or my wife's minivan, things like that.
I'll give you a better one. Half the people listening to this own their property, right? They got a small house on Main Street. They got a little building. They got an office condo that they own. And so they have a separate LLC and they charge themselves rent. Most advisors don't charge market rate rent. So when they do their P&L, they go, look, my business does $1 million a year of cash flow. And then somebody says, oh, this is great. So all we'll be paying for rent going forward is $3,000 a month. Well, no way can I do that. Easily, this is like $6,000 a month. Well, you're not charging yourself $6,000 today. So we got to back that out of the EBITDA because we got to figure out what the ongoing rent rate is. So like a year before you sell, at least get yourself market rate or create a lease between you and your building to make it market rate. Like these are things advisors do not think about before they sell. Now, the second piece is the legal piece. I cannot tell you how Swiss cheesy the legal agreements are in most practices. The employment contracts that people have, even the 1099 contracts, vendor contracts, operating agreement. Lewis, we had somebody we took to market and I never made this mistake again. I never looked at their operating agreement. And they basically said, yeah, the lead advisor said, I make all the decisions. But in the end, it was unanimous for sale in the operating agreement. So it's stuck down the road because I'm like, well, if every partner, even if they have 2%, doesn't vote yes, we can't sell it. And every advisor's like, don't worry about it. Everyone goes with me, Lewis. They'll do whatever I tell them to do. I can't tell you how many times I've heard that. And it's just like, it just doesn't pan out that way.
That's great advice. Maybe you just answered my next question, which is, what's one great piece of advice you'd give to an advisor or team thinking about selling in the next few years?
Well, get your ducks in a row with those things. If possible, make sure that you've got a G2, that if you hit the bus, it's more valuable if you have a G2, and get some sort of organic marketing. By the way, referrals is not a strategy. So get some other organic marketing thing going, and all those things will give you a better chance to get a higher value for your business.
Totally agree. Last question for you. Give me one bold prediction for the next few years. And maybe give me multiple, because you always have hot takes. So I'd love to hear what you think.
Well, I think what you're going to see in this business in the next couple of years is a shift from your large RIAs being the only aggregators, and you're going to see massively well-funded insurance companies get knee deep into this space, part because they have the money and part for cross-collateralization. A great example is a company like AmeriLife. I bet you when I say that name, most people around here are like, who the hell is that? And you might say that, but they're a massive company, have done lots of acquisition, and they're growing, and they like people that sell insurance products. So that's just an example of a company I've done business with that has done a nice job.
Give me one more.
To me, I would just say my other bold prediction is that AI is not going to have any impact on how fast you can grow your business or not. I know it's like, listen, I've looked at Jump for like Redtail, and sure, you'll get better at note taking, but I've been around this business for 35 years, Lewis, and people said, discount brokerage, Charles Schwab, it's going to blow up advisors. 15 years ago was robo-advisor, and today it's AI, it's all that stuff. In the end, if you do a great job, nothing can replace the humanity of not only the financial advice, but the emotional consult that we give families along the way. And just remember, you aren't in the money management business, you're in the relationship business. And maybe AI will be able to be in the relationship business one day, but I don't think for a long time.
Yeah, so you're talking about AI replacing advisors, but
Yeah,
I would have to think if I can shave 5 hours off of my normal workload, and I'm not just going to take that time to go golf on Friday, but I'm going to use it to be out there and networking and building my marketing machine, that there probably is a world where AI can make advisors grow faster.
10 years ago, people told me nobody's going to write checks in 10 years. And yet, pretty much everybody writes a check a year. So it's just like these things take time. And so just realize that don't get caught up in that psychobabble. Just keep doing what you're doing and servicing clients, and you're going to be in good shape.
Well said, Ted. Well, this has been so much fun. I always enjoy talking with you. I always learn new phrases and funny analogies, but also I think your advice is right on. Clearly, you've walked in advisors' shoes, you've seen the traps, and I think our audience is going to greatly benefit from your perspective. And also, it's a good reminder of some of the insights you get from hiring a professional advisor.
No doubt. Well, I appreciate you and everything you do, and thanks so much for having me on today.
As a financial advisor, you hold yourself to the highest standards of integrity, honesty, and credibility. You are successful because you take your professional responsibilities seriously and are dedicated to your clients. But are you living your best business life? Are your goals aligned with your firm's, or could a better option exist? Should I Stay or Should I Go is a book written with you in mind. It's a self-guided journey that walks you through the key steps that we take with our advisor clients. This strategic thought process and roadmap to professional self-discovery is designed to help you ask the right questions and think critically and objectively, whether you're considering change or not. Learn how to get your copy at diamond-consultants.com/thebook.